Welcome everyone to my March 2022 market update. In what's unlikely to be a surprise to you, I have a negative quarter to report to you. Not all bad news, but probably more bad than good. This slide shows the growth of $1 invested in various asset classes for the 3 months ended 31 March 2022. The top performing asset class this quarter was Australian shares in Australian gold, which would have grown to $1.04. Down the bottom, somewhat prophetically in red, was emerging market shares. That's the asset class that previously had Russian shares in it. $1 invested in emerging market shares for the quarter would have fallen in value to 92 cents. A 50-50 mix of shares and property and cash and fixed interest would have fallen in value to 95 cents. Not a great start to the year. Ordinarily, I would move straight on to 1 year returns, but I wanted to pause and remind you that while negative quarters aren't always that fun, they aren't actually all that uncommon. This chart, taken from our 50-50 investment policy statement, shows the incidence of gains, positive returns, over various time periods for the 30 years ended 2020. On average, 78% of the quarters over that 30-year time period produced positive returns. That means 22% produced negative returns. However, as we increase holding period from 1 year, 2 year, 3 years and longer, the incidence of negative returns decreases before disappearing altogether. So, while not fun, negative returns should be expected from time to time. This slide shows the growth of $1 invested in those same asset classes, this time for 12 months. The leader this time is global infrastructure, where $1 invested 12 months ago would have grown to $1.19. Bottom again is emerging market shares, where $1 invested 12 months ago would have fallen in value to 89 cents. That 50-50 mix of shares and property and cash and fixed interest would have grown to $1.01. Not a great year. However, while 1 year is interesting, it isn't long enough. I always say we need to look at least 3 years data. Here is the growth of $1 invested in those same asset classes, this time over 3 years. The leader this time is unhedged international shares in Navy, where $1 invested 3 years ago would have grown to $1.49. In second place is Australian shares in Australian gold, where $1 would have grown to $1.40. Middle of the pack is that 50-50 mix of shares and property and cash and fixed interest, which would have grown to $1.18, despite including a period with the COVID crash, inflation re-emerging, and Russia invading Ukraine. War, what is it good for? The only answer here is the obvious one. As Edwin Starr iconically put it in his protest song about the Vietnam War, absolutely nothing. Russia invaded Ukraine 24 February. Obviously, the human cost is the one that we're all concerned about. I think we all hope for a peaceful solution that respects the integrity of Ukraine's sovereignty soon. But as financial advisors, we are naturally interested in the impact the war may have on markets. We turned, as we usually do, to the evidence to see what impact war has had on share market returns in the past. When Russia invaded Ukraine, most people expected markets to fall. Counterintuitively, while they did start the day down, they actually ended the day up. Led by the S&P 500, the largest market in the US, most markets closed the day in positive territory. Despite our intuition that markets will perform poorly in times of war, historically, war hasn't made a great deal of difference to market returns. We investigated the impact on the S&P 500 of 15 global conflicts dating back to when the US entered World War II. On average, the one-day loss of the S&P 500 was 1.1%. The average total drawdown, from start to bottom, was 5.7%. On average, it took less than 30 trading days from top to bottom, and less than 60 trading days from bottom to recovery. Both those figures are almost halved when we exclude World War II. While no war is ever the same, the S&P 500 has largely shrugged off all conflicts and relatively quickly, with the notable exceptions of World War II and the Iraq War. The moral of the story is that we should be careful when drawing conclusions on the direction of markets based on news. Markets do often stumble on negative news, but these stumbles are typically short-lived and markets return to what they do best quickly. Thank you all for watching. I look forward to updating you again throughout 2022.